Joining us right now with a look at the interest rate environment, President Trump's executive order aiming to broaden access to private markets and retirement plans, and so much more. We got a lot to talk to with this gentleman. Marc Lipschultz is here, co-CEO of Blue Owl, oversees 200. I can't even believe this number now. This is crazy. We've known you a long time now.
Yeah.
$284 billion in assets under management, sir.
Great to be here.
Congratulations on that.
Thank you. Well, that's very nice of you. Appreciate it.
Let's talk. Let's do interest rates real quick, and then I want to get to the sort of the larger private markets situation.
Yeah.
I think we are going through almost a generational change in the financial market potentially. When you think about where the interest rates are today, you think about the Lisa Cook situation, you think about the tariff situation. Are you surprised that this is where we are?
So I'm thankful to be in the business we're in, where we do, as you know, products that are intended to be durable to whatever rate path we're on. So at some level, this sort of, let me call it, generally speaking, higher for longer, I'm not surprised about at all. You know, we've seen this, and we talked about this the last time we were together, when we just look at the fundamental, number one, the just cost structure for American businesses in general. Well, certainly inflation is well off its peak. It's not gone. And number two, like, what's a normal cost of capital? Part of this is relative to what? You know, we had this long, distorted period of time where rates were zero. That's not normal. Having, you know, Treasury rates in the 4-something range is rather normal.
But given everything you know from your own portfolio in terms of how businesses are doing, do you look and say, Jay Powell's too late and he really needs to cut interest rates? Or do you say, I don't know, I want to wait it out?
Business is good in our portfolio.
Okay.
The reality is we have about 400 companies now that we lend capital to, almost all here in the U.S., so a reasonable indicator. And business is good. I mean, the last quarter's performance, on average, we had businesses that were performing basically double-digit growth.
And so does that suggest, what does that suggest?
Well, it suggests to me the economy is sound and solid.
So you don't need to go lower.
Look, I'm thankful that I don't have to forecast the rate, as I said. Right. So I don't know the right path. I have a lot of confidence in the Fed, and I have a lot of confidence that we'll get there. But I don't know if it needs to go lower sooner. I do say this with confidence. We're in a world where we're going to be in I think higher rates overall for longer, number one. And two, there's a lot of exogenous variables that make it awfully hard to say the answer to.
Does this whole Fed independence idea concern you, and do you think it will appear in rates at some point or in the market?
Look, at the end of the
moment, it does not, obviously.
At the end of the day, I think we have incredibly durable markets, and I have a lot of confidence in those markets. I really do. And we have a really durable economy at the moment. And
so you don't think, you think all of this other stuff is noise to you? How do you?
I don't like to minimize the significance of, you know, anything when we're talking about the Fed, the economy. But at the end of the day, I do believe we will be fine. Right. We will endure through. And in the grand scheme of things, yes, a lot of this is noise as long as we continue to have a sound economy underneath it.
Mark, if you did think that the independence of the Fed was in jeopardy, that might actually appear on your radar screen at some point. Let me just say about Lisa Cook, because I know how we've covered it here. If she had 3 different properties, all listed as primary residences, and renting all of them out, if that actually turns out to be true, what's alleged, would removing her trouble you in terms of this administration trying to pressure the Fed? Is that something that you would say, wow, I don't like this and I'm worried about Fed independence?
Yeah, we're way out of my depth now. I'm an expert in lending.
You're the person. You got 280
data centers for leases, data centers for companies.
You would have thought the world was ending based on how certain places have covered this. So you're not ready to sell $284 billion worth of treasuries because of angst about this situation then? That you haven't done one thing differently because of this?
We're here to provide capital.
That's what I mean. But you're the one that's one of the people controlling where bond prices go.
We are certainly comfortable continuing to be a provider of capital. In fact, right now is a good time for us to provide our long-tail.
So this is part of the noise that been talking about noise a lot lately, and sometimes you have to ignore the noise to make your investment decisions, I guess.
We spend a lot of time looking for the signal. That is for sure. And there are some wonderful things in the marketplace for us to fund. I mean, there are.
Let me ask you a different question, which is, at the beginning of this, I said there's almost a generational change happening in the world of financials, if you will. This idea, and it comes from part of this new Trump bill, to make private investments more accessible to the public, into possibly 401ks, it's possible we're going to see a flood of these sort of semi-liquid instruments and other kinds of things in the marketplace. Is this a good thing? Is this a dangerous thing? What is this to you?
You know, well phrased, which is to say there's this generational change, and that I think is real, and that is good. Will there be a flood? I hope not. There should not be. You know, this is about walking before you're running. It's about creating an opportunity for retirees to participate selectively in private investments. There are clearly advantages to private investments. You know, if you look, again, we're in a mundane side of the private investment world, right? We do things like direct lending. But in direct lending, the data over any period of time is in. Look over a year, 5 years, 10 years, 20 years, rough justice. You have private lending performing about twice as well as the liquid alternative, about 5% in the liquid market, 9-10% for the private
Here's the
market.
issue, or the concern that I have in terms of how you make it right. One is the disclosure that comes from a private institution is obviously not nearly as robust as what you get from a public institution. That allows potentially for fraud or other things. I'm not suggesting that's going to happen from you, but from others you just don't know, right? Two, you have the semi-liquid, sometimes, depending on what the vehicle is, these semi-liquid vehicles, which in theory work when they work, but in theory actually don't work when they don't work. Like, that's actually part of the theory, which is they're built so that, you know, firms can put up gates effectively, and that creates its own problem on the other end. And so, yes, if you're a retiree, and look, if you have 20, 30 years, maybe this is a fabulous way to do it. The question is, if you're hitting 65 years old and all of a sudden you need that money, now I'm looking very far out, and in that moment you can't get the money, well, that's a whole other problem.
This is about doing it right, and I agree with you. I'm not an advocate for all alts all the time, you know, let's sort of, you know, spam the waterfront. I think what we ought to be doing, though, is making prudent options available for sure, because today we have this odd island around 401ks. Remember, other retirees are benefiting from direct lending, from private real assets or GP stakes, because they're part of defined benefit plans. But, so we have this island we've created, and I genuinely say it's not fair to those retirees. Now, they do need to be well advised. It should be well regulated. I'm sure the DLL will do it.
But let me throw one other thing into the mix right now, and it's a sort of a current issue. Most private equity firms right now are holding onto a portfolio that they can't exit from. And the only exits that are really happening are these sort of what I call hot potato deals, where everyone's selling their pieces of their portfolio to each other, frankly. And there's all sorts of marking games, which is another piece of this problem in terms of disclosure. But nonetheless, my concern is you have a flood of retail capital that comes into this space, and this becomes the opportunity set for all of these exits. And who is holding the bag? The retail folks. So
we're not in private equities, you know. My strong view is let's start in the places that are lower volatility. Let's start in the places that are safer. We don't have that issue in private credit. We don't have that in real assets. Let's do data centers where Microsoft is the tenant. I mean, there's a lot of very low volatility, low risk ways to participate. Let's work with our partner is Voya. Incredibly prudent firm. These are people that take care of their 10 million clients. So it has to be done right. Again, you will not hear me say this is about let's just go for it all the way in. Let's, in fact, start with some really prudent products. Let's do this smart. Let's do it well. And that will be good for retirees. And that will be good for our industry.